Hello and welcome to BQ Prime. A very good morning to all the viewers. I'm Hiral Dadia and you're watching Stocks in Focus. Overall, if you see the real estate pack has been in focus, and clearly, if you see the kind of institutional money also that's coming into the sector has been really huge. Overall, if you see from an investment perspective as well, there is a lot of interest in the stock market, and from a buyer's perspective as well, the demand stands absolutely strong. To discuss more, taking into consideration the way Q2 has panned out, joining us on the show today is Puravankara Projects. We have with us Abhishek Kapoor, Group CEO. Abhishek, good morning and welcome to the show.
Thank you, Hiril. Very good morning to you too.
Abhishek, firstly, the highest ever quarterly sales is what Puravankara has posted in the second quarter of FY24. And so, congratulations for that, firstly. Secondly, you also have seen a similar trend with other real estate majors. What's your key takeaway from the highlights that have been posted so far?
Hiral, the view is that industry is clearly consolidated with a smaller number of strong branded players, and that consolidation and the growth in market is enabling larger branded strong players to get more and more market share. So my view personally is that this is a long-term real estate end user driven demand cycle, which we believe that shall enable the larger players to take on more and more business as they deliver. So, Puravankara being in the business for more than 48 years, we have a very, very strong presence in 9 cities. And our goal objective is to ensure that we take more and more market share. And hence, you are seeing about 100% growth right now from last year versus this year.
Right. So, overall, the way the quarter has been, is that something that the company will be able to mirror in the coming quarters as well?
You'll see typically the third and the fourth quarter is better than the first 2 quarters because of the festive season, etc. Our intent is definitely to ensure that we perform in a similar fashion in the coming quarters. Our launch pipeline is quite robust. We have a total of 15 million square foot, which we had planned for the launch, of which we were to open about 7 million square foot. Of this, as of now, we have taken to market only 4 million square foot and opened about 2.5 million square foot for sale. So I think there is enough headroom for us in the next 2 quarters, which is the December and the March quarter, to perform in a similar fashion.
Okay. And how are you seeing the demand scenario? Because you have distinctly divided the segments into 3 brands, which is Purva, Provident Housing, as well as Purva Land, all targeted towards a different target audience. Where are you seeing the traction?
Look, it's quite homogeneous currently across all 3 brands. We are seeing a great amount of traction in Puravankara, Provident, as well as Purva Land. So it's pretty consistent right now and cutting across regions. Our recent launches and the upcoming launches are largely in Bangalore, Chennai, Kochi, and Pune. These are the main markets, and of course Coimbatore. So we are seeing, in all 3 categories currently, the demand is pretty high.
Okay. And clearly, if you see the unit-wise contribution as well, you have the lower income, the affordable side of it still, which is a maximum contributor to revenues. Are you seeing a change in that trend, or do you think that is something that will be your focus area?
Look, affordable is a definition that first we need to have clarity on. Truly affordable is really under 40 lakhs. We are actually in the category of between 50 lakhs to a crore and say 20 number under Provident Housing, which is really mass housing and mid-income housing in that sense. Currently, we are seeing huge demand in that category, and we believe that demand is end-user driven. And as I said earlier, of course, Puravankara and Purva Land, together, all of these 3 brands are really, really performing, including sustenance projects. I must add that the sustenance numbers have gone up, while we are adding new projects and new launches.
Okay. And overall, if you see from a business perspective as well, how is the sales realization trend and the rate trend panning out so far, specifically in the key regions where you're progressing?
See, I think rates will have continued to appreciate. Any project from launch to completion, typically over 3 to 4 years time frame, sees anywhere between 50 to 70% appreciation. Annualized, I believe personally that high single digits is something that we will continue to see somewhere between 8-9% over the next couple of years, at least, if not longer. So immediate visibility given the demand supply situation. The fact is that today you don't have enough inventory. You're at about 12 months inventory across the country. So our view really is that even with the new launches that are coming in, the supply is not enough to catch up with the demand, and therefore we will continue to see at least high single digits, because also we are not seeing incremental huge increases in prices. I think the developers and the industries also become quite mature to know that we want to all do volumes and make sure that there is end user sustainable demand. So I think overall, I would expect that 8 to 9% appreciation annually. And of course, on project to project and micro market to micro market, you would see different trends, and that can change basis demand supply in those markets, because some of the truly uber luxury locations have really no supply. So those are outliers that we'll always continue to see. That's the way our industry works. But overall average, you can definitely anticipate 8 to 9%.
Right. And from a region concentration perspective, southern markets is where your strength is. You are expanding in terms of the western region as well, where you've said that you are going to probably eye 40 to 50% of the business from the western region. What's that goal, and how is the strategy panning out, on that perspective?
So you're right. Our target is that Western region will definitely scale. We are investing in the organization, in the team, in acquiring new assets. So continuously, today I'm in Bombay. We are continuously working towards new acquisition. I think we will hear some of those happening by March. And as we expand our presence here and add new launches in the next financial year, I believe that over next 2 to 3 years, we should be able to get to that kind of percentage. But having said that, that does not at any point in time mean that we will not have enough launches and business development acquisition strategy panning out in the southern market. As far as Mumbai specifically is concerned, we are very, very closely working on redevelopment projects, because we believe that's a significant opportunity here. Of course, joint development opportunities as well, because there are not enough outright opportunities available in the Mumbai market. So we'll continue to focus on these strategies as far as Mumbai and Pune is concerned.
Okay. So currently, if you have to look at the inventory that you already have in the southern market, where does it stand, number one? And number two, for the western market, if you're talking about Mumbai and Pune, where you are saying that 40 to 50% is what you will see in the next 2 years, what's the kind of land bank that you already have?
So let me give you the overall perspective. We have about 5.5 million square foot open for sale. In the first half of the year, we have already sold about 3.4 million square foot. So our velocity is quite good. Of course, our total inventory and total portfolio is about 45 million square foot, which we are working on cutting across all projects and all the brands. Coming to the west, today we have only 4 projects which are currently launched between Pune and Mumbai. But we are expecting that by the end of this financial year, we should add 2 more projects in Pune. And next year, we will add significant inventory. By the end of this year, we'll add significant new projects and inventory for the launches for the next financial year.
Right. And overall, is this a strategy of entering the Western market, something that majority of the builders are now picking up? Because Now, you're seeing a lot of names that were not in the Western region where they've started coming up, taking into consideration because there still remains an unprecedented absorption for residential units in these two cities, and the realizations are much higher.
See, I think you will see certain players going pan India in multiple geographies, especially the strong, larger players. So I think that trend will kind of continue. One of the reports sometime 2 quarters back said the total consolidation as of today is about 33% of the market. I personally believe, in my opinion, over next 7 to 10 years time frame, you will see that going up to 70%. So it's a significant opportunity for large, strong brands who have aspirations to scale to be able to take more and more market share. So hence, I think Mumbai, MMR, Pune, West being a significant market in the country, definitely you will see more players entering. And similarly, in South, we are seeing some players coming in from the West. And again, North is also panning out in the similar fashion. So you will see at least these regions having strong brands, having multi-regional play. So I believe that this is very, very, good for the industry because I think organized, strong players will bring in good quality of supply in the market and reliability on the industry as well.
Right. And with this, how is the debt picture panning out? Because overall, at the end of the first quarter of FY24, we did see the debt in terms of an overall increase that did come in as well. If you take the debt equity ratio into consideration, is this at a comfortable level, or are there plans in terms of reduction going ahead?
See, debt actually, if you look at the composition, very good question, and thank you for asking it. See, if you look at the debt composition, we are continuously seeing that we are repaying debt as far as residential is concerned. What is happening is that we are investing in commercial, and therefore debt has gone into creating capital asset as well as land. So I think what is happening is while debt is at a similar level, on a per square foot area of area under development, the debt has come down by 50%. So if you look at our numbers, and we kind of publish these numbers over last 3 to 4 years time frame, we have brought debt down from about 2,000 rupees a square foot on area under development to 1,000 rupees a square foot of area under development. We will continue to hold that position and possibly reduce it further because more and more projects will come to the market and we'll do the launches. What it means really is that every per square foot debt that you've got, let's assume that you are holding this debt over next 3 years, right? And you're going to land up paying a total cost on 2,000 rupees. You would have interest cost would have been about say 600 rupees over next 3 years. If I look at bringing that down to 1,000 rupees, which is the position now, that cost has come down to about 300 rupees. And therefore, 300 rupees has been added to your bottom line. What it means is that we are essentially using our capital very efficiently, deploying capital very efficiently, and speed to launch and the scale of operations versus debt is absolutely at a very, very comfortable level. Of course, what we will see over the next few years is that as we deliver, the debt equity in terms of what we have on the books will continue to evolve.
Okay. So when you talk about investing in the commercial side of it, how big is that portfolio and what percentage of revenue contribution is it at right now? And where do you see it in the next 2 to 3 years?
See, we currently have about 3 million square foot under production as far as commercial is concerned. Both the projects are in Bangalore and they will get completed. So currently it is not contributing anything to the revenues. We intend to deliver these projects by May of 25. And as we complete these projects, we will see rental incomes definitely coming in. On the monetization of these assets, our intention is at this point in time to rent these assets, and we look at the right value at the right time if we want to monetize these assets.
Okay. And the other aspect I want to talk to you about is the Starworth Infrastructure, which is the wholly owned subsidiary. Your order book of around 1,200 odd crores is what you have there. How is that business panning out, and how different is it from the brick and mortar that you already have?
So the contracting business really is focusing, it's a full EPC business. And the idea of that business is really to have a backward integration. While we work with all the large contractors, this is a business that we have created where we are focusing really on precast. We are of course doing hotels, steel plants, we are doing metro stations, multiple institutional business we are doing here. And what we see that is there is an opportunity at the mid level for a contracting firm to be able to scale and reach that mid level, because everybody else, which is the top 3 or 4 guys, are very large. So and there's then nobody below them, and then there are only very smaller contractors. So I think there is an opportunity there in the marketplace, and especially in precast. We will continue to see that business grow as we go along over the next 2-3 years time frame.
Okay. And when do you see the company back in the black? Because the first quarter we did see a loss, but taking the second quarter trend into consideration, what's the growth for? I mean, in terms of FY24, what do you look at?
I think that's more a matter of accounting and delivery. I think the moment we give possessions, the revenue recognition happen, and then you start seeing the numbers. The company is doing very well. The business is doing very well. We have very healthy EBITDA margins. I think it's a matter of time as we deliver. So today, what are we focused on really? We are focused on 3 things. We are focused on pre-sales. Second, focused on ensuring that the cash flow is catching up. For example, last quarter, we have collected 879 crores, which is growth of 70%, while our pre-sales has grown by 100% in excess of 2,700 crores for the first half of the year. In the last quarter, we've seen 70% growth in collections. So in constant focus on ensuring that your collections go up, which basically means that you are constructing fast for quicker realization of your cash flow, and hence your equity is coming back and your profits are coming back and you churn that capital. And then the third thing is obviously the debt level, which we spoke about, but we look at it a little bit in the context of the total business that we are doing. So as long as the business is growing much faster and the debt is at similar levels, overall average debt per square foot is under control, we are okay with it, right? So these are 3 things we focus on. Eventually, it will all hit the P&L as we deliver these projects, and then of course the balance sheet. So you will see that pan out because the accounting standards, because that changed in about 2017 or so. So that and plus COVID disruption has happened. So across the industry, you will see over the next 2 to 3 years, this slowly changing, and then it becomes far more stable, and it will start reflecting the real picture. The accounts will start reflecting the real picture of what's happening in the market today.
Right. And Abhishek, my last question coming to you, I'm sure you'll be hoping that that's something that will be asked as well. With regards to the search that was conducted by the Income Tax Department last week, if you could help us with an update as to what was it with regards to and what is the outcome?
See, real estate industry per se, there's a routine searches that happen across the board. And this was again a routine search that has happened with us on a periodic basis. It happens with everybody. And the update is really there was no unaccounted cash or transactions or irregularities found. And, the process will, as it takes its own time, will conclude. But the search was conducted in a very professional manner by the department, very in-depth, very thorough with protocols. And I think the process is getting into the completion mode now.
Right. So no impact from a business perspective.
None whatsoever.
We
are back in action.
Thank you so much. Absolutely. Great to see that as well. Thank you so much for joining us on sharing the views, and a pleasure to speak to you as always, and hoping to see a lot of Puravankara now back in the Western region as well. Thank you. Stay safe and speak to you soon again.
Thank you.
That's the management of Puravankara projects. Clearly, we've spoken to them with regards to how the sales are panning out. The company could be back in the black as well in terms of FY24, in spite of that loss number that we've seen in the first quarter. And with regards to the income tax department raids that were carried out, the company has clarified that they were the regular searches and raids that usually happen with real estate companies, and they are pretty much at the lag end of it, with no impact in terms of where business is concerned whatsoever. And the strategy with regards to their expansion in the Western region is something that the company is embarking on as well. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.